Okay, hello everyone and welcome back. My name is Greg Furman and this is the Vantage Point AI Market Outlook for the week of April the 29th, 2024. Now, to get started this week, we'll begin with the dollar index. Now, just a reminder, guys, this is a weekly outlook, not a monthly outlook or a quarterly or a yearly. What we discussed or what I discussed in last week's weekly outlook is that we had a reversal signal in the dollar index. And I had specifically mentioned that one of the deciding factors in this will be the Israeli-Hamas. I don't believe interest rates are a factor in this previous week because the Fed, as I had stated in the video, has gone into blackout. So interest rates are back on the table coming into this week as we have PMIs, we have the ADP report, the non-farm payroll number, and more specifically the Fed. So we have to make sure we can differentiate from one week to the next. I had also mentioned that we have that safety net. Because the Fed is in blackout, interest rates are not a factor the previous week. The signal from Vantage Point is, which gave us that early warning sign. I had further stated that this would be a corrective move lower unless we break down below the T-cross long, which we have not, 105.49. But very good dollar shorts, Euro US moving higher, Great Britain US moving higher, Aussie, US, New Zealand, all those pairs that had put this signal with the MA diff cross came to fruition. Now, in most cases, this coming week, we could see the exact opposite with dollar strength. It's going to be data driven. So the technicals here is this is what we wanted to see. Is it a corrective move lower? Which I had stated it is a corrective move lower unless we break down below this level. But more specifically, the quarterly opening price, 104.49. We're still bullish on the year. The dollar is net positive on the entire calendar year. So now this coming week, interest rates are a factor. It will be a very, very volatile, choppy week. As we can see, we have very little downward momentum on the predicted RSI. We have a reverse check mark. We've hit the 60 level and bounced off of it right to that level. Now, using a 60-40 split with the predicted RSI, we want to use the RSI as it's intended to show us momentum. So the dollar was starting to lose momentum actually on Thursday, and then on Friday, we rebounded. So again, a heavy data dependent week, but in my respectful opinion, interest rates, hikes, cuts, holding for longer, ultimately there is going to be cuts. The Fed can only spin this data so much, seasonally adjust the labor reports to make the reports look better than what they actually are. But again, we will see what the Fed's position is on Wednesday. But the CPI, this is a lagging indicator, economic indicator. It's the previous month. And I will point out, so is the non-farm payroll number. So we'll monitor the number. But the Fed will speak on Wednesday. We'll have some idea what the direction, what he's thinking. But always remember, this is the same guy that said he was going to cut 5 times in 2024, and he keeps flip-flopping. We've all seen this with this guy over the many years and other Fed chairs over the years that they're reacting to this data that is like the non-farm payroll and the CPI is lagging. So for now, the dollar is holding its gain. The T-cross long for next week, 105.49. My view is the dollar starts to move lower as we get into May and June, and we start to get real data and see that the U.S. economy may not be as strong as what they think it is. And some of these numbers, obviously, are manipulated in an election year. So for now, these are our 2 levels. The indicators from Vantage Point are already warning of a reversal back to the upside. I believe that a return back to the 106.50, potentially even the 107 level, is more than possible. But the core value we need to look at is that T-cross long as described in last week's weekly outlook. Because again, the Israeli-Hamas, that is in the forefront. That mattered last week. And as I had stated, if things settle down, the dollar's going to sell off. If things heat up, the dollar's going to go higher. But it's a corrective move. So I just want to clarify that this is not a long-term outlook. It's for 1 week only, okay? Now, as discussed in last week's weekly outlook also, that gold is likely to move lower. And as we can see, it has moved lower, but we're still holding along that T-cross long at 23.24. We're in a strong period, known seasonal period of gold strength that usually lasts until mid-April, mid-May, or late April, mid-May, excuse me. So our T-cross long, but we can see the structural bias of gold, 2066, our quarterly opening, 2233, and then we're coming in our monthly, that is currently 2233 also. This is a big area here, the T-cross long, coming in at 2324, and you can see how we've just slowly started to move back up. But again, this too now will depend on the incoming data this week, whether the Fed is actually going to hike and when, or going to cut, excuse, not a question if he's going to cut, but when. What does he need for a cut? My view is the conditions for a cut were met long ago, but that's just my opinion. And I've looked at the data. It's very manipulated, so I'm not going to hang my hat or make all of my decisions strictly based on interest rate. That I base it on intermarket correlations and the key levels, looking at where actual price is. That's why we don't get into a rolling performance model of moving these anchor points. We need to know exactly where our T-cross long is, our key reversal area, our quarterly and monthly opening, and of course the all-important yearly opening price. Is it actually bullish? Is it positive or negative on the year? If it's above its yearly opening price, it's making money. If it's below, it's not. So when we look at this right now, this is pointing to further gold strength right now. So again, that leans into my argument that this data is going to catch up to the Fed, and the Fed is going to flip-flop probably many more times this year. So I'm not going to base it solely on that. We want to look at the artificial intelligence, the intermarket correlations and inverse correlations, and quantitative analysis that measures seasonal moves on a year-over-year basis. So right now, gold is holding the line, but 2034, any kind of hotter economic data that implies there'll be no rate cut, then that is going to hurt gold. So we will watch this level very closely, but these indicators from Vantage Point are suggesting that this was just a corrective move lower on gold, not a new trend at this particular time. Now, the S&P 500, once again, had a pretty good week last week when we look at the factual numbers of what the actual performance was on a week-over-week basis, because again, we can't move this to a random 5 days. The S&P was actually up 2.27%, and that's the inverse correlation, the dollar dropping, the S&P 500 up. But it needs to get moving here. In most cases, the equities are not very strong at the very end of the month into the first week of the new month, because we have that known period of dollar strength at the same time. So again, we'll monitor this very closely, but we do have a short and medium term crossover. The predicted RSI 59.3, it just won't give us that 60 level to show upward momentum. And we're right on the T-cross long at 50.93. We must break through that area, but I think it's unlikely. The market is going to be very skittish until we hear what the Fed is actually going to do. So be cautious of a big spike up on equities on Monday, only to completely reverse on Tuesday. Now, when we look at light sweet crude oil, we're getting ready. We're getting closer and closer to our known seasonal pattern in oil. RBOB gasoline contracts as they switch over from winter to summer fuel. Closing above our T-cross long this week, 83.45. The next move would be to the verified resistance high at 85.64. I believe we can definitely get that. But again, when we look at that MA diff cross that occurred at the end of last week, the beginning of this week, you can see that that has progressed and oil has been slowly moving up based on that pink line crossing over the blue line. That means the medium-term trend is actually reversing and it's getting stronger. So I would look for a push towards the 85 mark, but probably not until Tuesday, Wednesday, until we hear what the Fed's most recent plan is going to be. But always remember, don't forget, guys, how many times every one of these Feds, and not just the US Fed, the Bank of Canada, the Australia, ECB, They're flip-flopping all over the place. So don't think you know exactly what these people are going to do and say, because 80% of the time they do the opposite of what the actual economic numbers suggest, and they base all of their decision on lagging economic indicators like the CPI and the non-farm payroll. So we'll monitor this, but oil still looks pretty good as we get ready for a known seasonal pattern. Now, when we look at Bitcoin, and I certainly do apologize, I missed it last week. Bitcoin basically just waiting for the Fed to see what he's going, what his plan is. But for now, let's always remember, guys, that Bitcoin is firmly positive on the year again. This is the second year in a row. Remember just a year ago when they told us Bitcoin will be back down at 8,500, 9,500. It never came to fruition. It held it above its current yearly opening price last year, and it's easily doing it this year. So if we look at where Bitcoin currently is, any one of this area, or if we just take it off the current yearly opening price, then we know exactly what the actual Bitcoin is doing here. So to suggest that Bitcoin would be bearish, well, that's a hard argument for me to endorse when it's up 51% on the year. So right now, I think that Bitcoin will take a bit of a dip down, maybe to the 59,000 mark, but I believe that area will likely hold. And it's the dollar, inevitably the dollar will weaken. It may not be next week, probably won't be, but in the coming weeks and months ahead, you can pretty much take it to the bank that that is incredibly likely that it's the dollar that loses its value. So right now, I would be prepared for 59.2, 59.323 for the week, and then we will see where we go from there. But the indicators here are basically sideways. You can see on the predicted RSI, using that 60-40 split, that we just don't have that downward momentum that we should. But if we can get it back above our T-cross long at 65,305, then we should take another run at the current quarterly opening price, which is 70,885. Now, one of the tricks that I often use in the VP software is I'll look to see where they forecasted this in the previous year. And as you can see, it was more towards the end of May into June when Bitcoin started to move back up again. But a lot of times you can go back and check this. You know, we're getting into the infamous 2022 and 2021 with COVID. We've got to filter some of that noise out. But either way, I often see this where I've got strong buying in Bitcoin at the end of May and June. So just another way of getting everybody out in front of this move, that we should expect potentially a little bit of downside on Bitcoin, but that would be a buying opportunity. Now, when we look at the pairs from last week, once again, Euro US following that MA diff cross that was discussed before, not after the move up on Euro US happened. The market was actually quite bearish on the euro and quite bullish on the dollar last week, where I wasn't, because I have a tool like the MA diff cross that warned me, again, that if nothing else, it's not going to go lower from here this particular week, but it can go lower from up here at the T-cross long at 107.14. This is the area we will monitor. As you can see, the same indicator that got us long last week could very well be the same tool that takes us short this week, this coming week. So once again, our T-cross long 107.14, that is a pivotal area, and the Vantage Point indicators are losing upside momentum. This would indirectly tell me then, okay, the US Swiss franc is likely to make another move here. It's the inverse to Euro US, one down, one up. So when we look at the US Swiss franc right now, we can see we're right on that T-cross long. That level coming in at just slightly under 91 cents. Strong possibility that this pair extends higher, but we've got a cautionary neural index at 11, the neural index strength right on the zero line, maybe a hair under, but no downward momentum. All our crossovers are still good above the zero line. And again, very, very important that we use these areas. If we are attempting additional longs on this, stop should always be below the quarterly opening, 90.21. Our T-cross long, though, that's the level we're going to watch for next week. Now, the British pound was very, very choppy at the start of the week, but again, that MA diff cross never crossed back down to the downside. And sure enough, there was a very odd article came out on Sunday evening last week, early Monday, that the Bank of England is going to probably have to cut in August. And in the VantagePoint Live training room, we kind of worked on that. And I said, well, isn't that unusual that somebody would be talking about August? Frankly, who cares about the interest rates of the Bank of England in August? So that caused the British pound to sell off basically for one day. And then it immediately recovered. So this is a very good example of staying with the contrarian indicators and trending indicators in the VP software, because it told me that, look, uh, these predicted differences are moving up, and that pink line did not cross back over. However, this week, well, now we could have a problem because we've had our corrective move higher. Now the T cross long 125, we need to get above this level quick. And we further need to retake the quarterly and the yearly opening price. But when we look at the factual structural bias of this, it technically is still bearish. We're below the yearly opening price, 127.32. We've got our quarterly opening, that and monthly opening, excuse me, is both the same for this month of April, 126.31. So yes, structurally this is bearish. But a very, very good trade right off the start of the week, because if we look at this and we look where we started the week, on that reversal signal, we can assess here that that was even if we go up to the open on Friday where we get out, that corrective move, as long as you can identify that, which I try and do for you guys each week, that's a pretty good move of 1.18% on a single currency pair. Very good move, I might add. So 146 pip on a single contract is about $1,460. Not bad for a week's work, guys, if you look at these contrarian signals, but then we also have a price target using our T cross long at 125. But the main thing is, this is an outlook, not a recap of something that already happened. The idea is that we can get in front of these moves the very second the market opens each week, or be prepared for reversals, which I think may happen on the dollar back to the upside Tuesday, Wednesday. But the main thing is know your levels, guys, and utilize these particular trading tools. Now, the dollar yen, I think we're all waiting for intervention here. Hard to believe. I've never seen this in my trade, 30 plus years. I've never seen the dollar yen at these levels. Absolute it's crazy. So I think the Bank of Japan, I would be very cautious with longs and shorts on this particular pair. This indicator, or basically the dollar yen pair has been overbought for about a year. But all joking aside, it's been overbought here, guys, since March, and it just keeps pushing higher because the Bank of Japan is not intervening. They're not doing anything. So I would be very, very cautious trading this pair, and I will limit any analysis on it because the fundamental of the Bank of Japan not intervening or not intervening, that's the only thing that's driving. And of course, that all important carry trade, which people are reluctant to leave. But what I will warn you is when they start a mass exodus out of this carry trade, and this goes for all Japan pairs, Euro Japan, CAD Japan, Great Britain Japan, this trade can be turn ugly very, very quick. So adhere the warning that I'm giving you if you're trading anything with the Japanese yen in it. Now, the Canadian dollar should start to see some kind of strength going forward here in the weeks and months ahead as oil prices start to pick up. You can see very, very sneaky how it holds below the current weekly opening price. And again, when we're using a weekly, monthly, yearly opening price, it needs to be anchored properly at the beginning of the week, the beginning of the month, the beginning of the quarter, and the beginning of the year. And we use that level as a good supply and demand area, or an area to determine whether we're bullish or bearish on the overall trend. Well, the overall trend on US Canada is still up, but I do anticipate the potential of a corrective move back towards that yearly opening price the closer we get to May and June in summer driving season. But for now, these predicted differences on Vantage Point, as I had discussed last week, this MA diff cross, it commenced literally weeks ago. Excuse me. So when that happened, We always take that one of two ways or both. Number one, I do not want to continue to buy up here when that pink line crosses the blue line. And number two, it would be identified as a corrective move until such time as we break down below the T-cross long. So 136.75 is going to be our line in the sand, but the additional support for next week, 135.45, this is going to be driven by the S&P 500. If it goes up, US Canada goes down and vice versa. Oil and gas contracts usually benefit the Canadian dollar in about another couple of weeks from now, but it looks like they're already starting to pick up the CAD now. So if we can stay below that, then we will have a short for this coming week. And if that trade works, on the short side, then you can anticipate that the Aussie US and the New Zealand US will also move up. Now, the Aussie is the one that I found particularly interesting because, again, the signal that I discussed last week was based on two things. What happens with Israel and Hamas, or Israel and Iran? Then when we look at that, we also look at the thing where this is going higher, and if it's clearing that quarterly opening price, then we may have something here, but we need to stay above this particular area, okay? That quarterly opening price is what we need to hold above to get a retracement back to the current yearly opening price. That is the key level that we need to deal with here, okay? So that quarterly opening price is coming in at 65.20. If we hold above that, we hold above our T-cross long at 64.97, we get further upside. The same thing. This is the exact same trade, guys. And if anything, the Kiwi is doing what is either lagging behind the Aussie currency, okay? Or in the alternative, it's warning us that the Aussie break higher is a false break. So we don't have a completed three-way crossover on this, but it's getting close. So I would keep an eye on this. We have a very heavy data dependent week next week. PMIs, the Fed, non-farm payroll number. You can expect a very, very choppy, volatile week. So with that said, this is the Vantage Point AI Market Outlook for the week of April the 29th, 2024.